So we're on a Wednesday evening and we're all here to talk about one thing, which is fun, how to invest in property with a self-managed super fund. I'm not sure how many of you are familiar with what an SMSF is. We're going to go through about that into a bit of detail. It's a really broad area. It takes a lot to understand, but what we're going to do is just give you a basic understanding of what an SMSF is, what an SMSF can do, how you can buy property within that, some few little tips and tricks to be careful of because you don't want to do the wrong thing in this, and we'll go into that a little bit depth later. Tonight it'll be myself and Justin from Precision Private Wealth who will talk about this in a bit of detail. Just a quick bit of boring information. The important information here, that this is obviously general disclaimer. This is a very complex area of advice, and what we're providing here is only general information only. There are really significant penalties for non-compliance with SMSF, so it's really, really important that you do the right thing in this area, because there's not only significant tax penalties but potentially even criminal charges. So you really want to make sure you're compliant if you do want to look at buying a property within a self-managed super fund. Just make sure that whenever you are considering this, that you seek personal financial advice for your specific circumstances, not only to make sure that you're within the law, but in the end, if you're setting something up, you want to make sure it suits your needs and your goals. The last thing you want to do is set something up which only sets you backwards over the long term. This webinar is being brought to you by Precision Funding and Precision Private Wealth. Precision Funding is a boutique investment-focused mortgage broking firm. We provide clients with strategic investment lending advice, helping clients to grow their portfolios beyond traditional means through a holistic approach to finance. Really, our goal is there to help people be able to grow more and make sure that their structures are there to help them buy more property and not hinder them. Our services cover credit advice in broking across residential, commercial, business and SMSF finance. I'll get Justin to talk about what Precision Private Wealth helps and why we went in that space.
So Precision Private Wealth is a financial planning business which provides holistic financial advice services for property-focused investors. So we saw a gap in the market where there wasn't too many financial planning businesses providing advice specifically for property investors. So we have a holistic approach, and we take into account the client's property goals and investment needs and understanding of how this sits into their overall financial position.
Perfect. Thanks for that, Justin. So basically, I think the main thing we really need to start off is, what is an SMSF? So what is a self-managed super fund? What are they? How do they really work? An SMSF is a super fund, so where members are the trustees of their own fund. So instead of where you may normally have your super fund, which is managed by a third-party company, an industry fund, a super fund which might have been a corporate fund for your workplace if you're in a large workplace, that's really common. Instead, this is a fund where you yourself or up to 4 members can combine your funds together and run your own fund, define what your investments are, how you want to invest in them, where you want to invest in them, and then really take control of your own sort of long-term retirement goals there. Running your own super fund gives you greater control of your super, more flexibility and investment choice. The key obvious one here is investing in property. You can't borrow money and leverage yourself in a retail super fund like you can here in this sort of circumstance. You can pick specific properties in a self-managed super fund as opposed to just being put into a normal fund. As an alternative, it's really good as an alternative to those large industry funds and retail super funds, because in the end, if you're going to make a choice, at least that enables you to make a choice of what investments you want to engage with, or maybe at a time when you feel the market isn't where you want it to be, whether you want to be in the market or out the market. As I mentioned just earlier, a self-managed super fund could have a maximum of 4 members. It's very common. You see family members together, sometimes intergenerational, so husband and wife and 2 parents, those sort of situations is really common, or children involved. The fund has a trustee, just like a trust has, where there's someone who controls it. The trustee can either have an individual trustee, which is, say, the members of the fund, or even a corporate trustee, which is where you can have a company which the members control, and that gives it an extra layer of protection, which most of the banks are really looking for you to go down that pathway. So if you are looking at building yourself a self-managed super fund, just take note of that you really want to consider a corporate trustee. It's going to allow you to borrow more. The deposit requirements are lower, and some lenders just won't lend to you unless you are a corporate trustee. So it's just a real important thing there. The downside, if you were to consider it, is it's just an extra fee to get the setup of the corporate trustee and the annual fee from the ASIC to pay for that. But that's a couple $100. But it's one of those things that you have to consider. Does that really extend your potential further? If it is, it's well worth the cost. A few other little things about it. No member is an employee of another member within the fund unless they are related. So you can't go having all your workers under your self-managed super fund. It really blurs that line of sort of, are you members are working together, or is there a bit of a power relationship there? No trustee of the fund or director of a corporate trustee in that corporate trustee circumstance is paid for services performed within that fund, except in real limited circumstances if they are a financial planner themselves and there's justified management costs and that and the like. Overall, it's not something you should really consider as a main way of generating income. Really keep that super separate and really define those lines there. Don't blur it. In terms of self-managed super funds and residential property, I'm not really going to talk about commercial all that much here because it is such a big field to start with, and commercial will take up hours to go through, and it will be another webinar we'll do in the future. So anyone who's listening to this, we will put one of those out in the future. The main things with residential property, there's some real keys, do's and don'ts. So for a do, you need to meet the sole purpose test. It's really important that they see that that's what that investment is for. You can buy an investment property, a house, unit, etc. You can buy new property, so that off the plan. But just as a lot of investors shy away from off the plan these days, just because there's a lot of issues around valuations, the banks which fund self-managed super funds are really shying away from it too. So some specifically have rules against lending to brand new properties because they don't want to see investors putting their entire retirement funds into a property which may not be suitable, have very strong performance, or may be overvalued and use a lot of the equity up from day one. So sticking to those houses or units, which there is a sort of an argument though that you don't want it too old, just because some of these rules I'll go into a little bit later. But the main thing here is stick to those houses, units, apartments which are already established. You must acquire it from an unrelated party. What does that mean? It means you can't have your wife own an investment property and the husband then cannot buy that property with a self-managed super fund. They have real strict rules around these sort of things, just like you can't sell it to your own super fund. It's really important that you don't do that. In commercial property, that is something which is possible, and there's a few little tips and tricks there. But once again, we'll go through that one another day. Getting that understanding residential will really help you understand how the commercial side works later. Rent must be at market rates to an unrelated party. You can't go renting this to a sibling, a friend at below market rates, because it's showing that you're getting a benefit out of the super fund, which you're not meant to. It's meant to be really for the investment and making sure that it's really working to your long-term future. The don'ts really tick off the sort of the opposite of what we've just talked about. You can't buy your primary residence in a self-managed super fund. You're getting a benefit out of your self-managed super fund then, and you're not allowed to do that until you reach that retirement phase. Likewise, a holiday home or a home where you have a family member stay in it or any along those sort of things, you can't buy it as an investment property and then decide you want to move into it. If you do that, that's going to cause some significant tax issues, make it non-compliant. Like I said, there's even chances of criminal charges, and you just don't invest to get yourself in jail one day. It's one way to retire with limited income, but probably not a nice retirement nonetheless. As I said, you can't rent to a member of a related party, family member, etc. You just don't do that. So how can you lend to a self-managed super fund? How does that all work? There's a few little bits and pieces there. There's both what the legislation says, so what the government dictates, and what the banks say. So the banks follow what the government says, but sometimes they even have rules which go above and beyond what the government says, because the banks themselves are very concerned about stepping outside of the law in the self-managed super fund space and the super space, because it's such an important area. When you're talking about someone's retirement, the government is very concerned because they don't want to see you guys become pensioners. They want to see you self-funded retirees in the end. So how does lending work in a self-managed super fund? Similar in some ways, different in many. Don't try to relate normal residential finance to self-managed super fund finance. So in other words, anything you remember about buying investment properties or your own home in your normal personal way, put it aside, because more often than not, the rules are very, very different. There's really specific legislation and very specific lender policies which make a different type of finance. Some of the key differences there is your borrowing capacity. It's treated different to normal lending in the sense that it looks a lot more at what does the super fund produce? What does it receive in contributions? So if you're working, you're paying super guarantee into that funds, or your workplace does that on your behalf. That 9.5% where we're currently at is going in there each year. That's treated as income. Likewise, they can see if you've got any existing investments with it and it's returning value there, and say dividends, or if you already had a property within there, that all gets added into the mix. That's what really helps you grow there. What it also does is it, in some cases, disregards your personal financial situation in terms of borrowing capacity. What's interesting, what that means is that while there's circumstances where if you've built a large portfolio and you may not be able to borrow any further in your personal name, you may then be able to look at your self-managed super fund as a new vehicle to keep borrowing and investing. So when you might be at a point where, while you might have strong cash flow on a portfolio which doesn't really cost you anything, with the changes that APRA and the lenders have really put in place thanks to the government regulator about restricting people's ability to invest and build a large portfolio, now you can look at it as a two-stage process. A process where you start maybe in your own names, and then when that really gets exhausted, you still have that capacity to then look at the self-managed super fund. Deposit requirements are very different in a sense. We don't have the same sort of lender's mortgage insurance regime in self-managed super funds as we do in normal property. What that means is that generally the upper limit is 80%. A lot of lenders are at 70%. Now, some lenders are 80. The obvious example that you'd want to go for an 80% is if you've got a limited deposit, an 80% lend is going to be easier to get that purchase done than a 70%. Quite obvious. But some lenders at 70% have features and products which might actually be a bit more beneficial, and that you may take that extra 10% deposit and it's going to allow you to do a few little nifty things. One example of that, offset accounts. So if you want to get a great offset account with a good product, you're generally looking at a 70% LVR. Not all lenders, and most of them, aren't providing offset accounts to self-managed super funds. Offset accounts are incredibly important for a self-managed super fund. It's because the legislation says that you cannot refinance and draw equity out of an existing self-managed super fund property. So if you pay it off one day, you can't pull it out. If it grows in value, you can't pull that equity out. Once you've got that loan on it, that's the maximum loan you can have. Where an offset account then becomes important is if you've got extra money in that super fund and you just want to offset that loan, you don't want to pay it off because you can't take it back out. What you may instead say is, I'll put those funds in the offset account. You can draw that right down. You may very well get to the point of paying it off. I'm going to show you an example a little bit later, which is going to show you how quickly that can happen. And then by doing that, you can then draw the funds out later, keep investing, buy maybe another property or shares or any other sort of goal that you have is your plan for your fund. But at least that offset account allows you to do that. That's really important. The interest rates and fees are higher. They certainly are. Application fees can be between $1,000 and $2,000. You may be paying for ongoing fees, you may be paying for annual fees. There is a bit of variance in the marketplace, but overall the interest rates are higher. For your standard sort of big four level of self-managed super funds, you're looking at the mid to high 5% range at this time. There are some really good independent second tier brands, however, which have come into the market, which have got their interest rates very close to current interest rates for investment properties. So it's really important to consider when you're looking at finance for a self-managed super fund, don't be biased to that familiar big four name, because you may find that you're paying a high premium for a lender. The big four, they're just not looking at that sort of smaller niche market. They don't want to specialize in it, so they're not willing to really give a discount to really lure people in. Whereas there's lenders out there which now have really great products, borrowing capacity and policies out there for the self-managed super fund investor. And that might be something which will get you a little bit further. We've done borrowing capacity models which have shown some of those lenders will actually allow you to borrow upwards of 2 times what some of the big 4 lenders or your traditional lenders that you may be more familiar with. So there's a lot of benefits in considering the broader scope of the options available. As we mentioned, equity releases, re-leveraging, they're disallowed due to legislative restrictions. So making sure you have access to an offset account or making sure your strategy of investing means that you're not being inefficient. So make sure you consider it's not always about leveraging your loan to the highest LVR. It's about having a good balance. Depending on the lender and depending on the amount of funds in your balance is really going to depend what's the right lender for you. You may choose to pick a higher interest rate but have more opportunities. A really good example that I'll give you is that we have a client that we worked with recently. They have enough funds in their self-managed super fund to buy a property outright, but they actually want to buy 2, but it may be a year between purchases. So by having an offset account, what it's enabled them to do is make the purchase, put the funds fully in offset, so they're not paying interest while they wait, and then in 12 months' time, when they want to make that next purchase, they can draw from that. Likewise, if they want to put it into shares or other options, they can do that. But it's a lot better than them having in maybe a slightly higher LVR loan or a slightly cheaper interest rate, and then find out over that 12 months they've got to pay 5-6% anyway in their interest rate, and they're losing that down the drain. So that's where it's just thinking practically about your scenario, what really suits you. Another real important part in there that throws a lot of people off is the minimum balance or liquidity requirements. So a liquidity requirement or a minimum balance, there's 2 different types. So some lenders now are saying that they won't lend to you unless you have $150,000 or $200,000 or $250,000 in your fund. Now you may not need anywhere near that amount to be able to invest. So for instance, if you're purchasing a property for $400,000, you mainly need to utilize a deposit of $120,000, $130,000 overall for everything. So having that requirement for $250,000 with a number of lenders is just absurd. But they put these in there because, once again, they're not too interested in taking a lot of clients on that. They more do it to, if they have a client where they have everything else, they just have it there just in case they can try sell them that too. They're not interested in really pushing into that market. So where this means there's a bit of diversity in the market is that some lenders out there don't have a minimum balance requirement, but they may have a thing called a liquidity requirement. This may mean that they say that we want you to have 10 or 20% of your fund's initial balance left over after the purchase and keep it in cash or shares or just something non-property related. So to give you an example, if you had a fund of $100,000 and the bank had a liquidity requirement of 10%, you'd need to have, for your purchase, a maximum of $90,000 towards the deposit. You can spend less, but you're just not allowed to use 10 grand of that super fund. It has to either be sitting in cash, in an offset account, in shares, something liquid. So the key word there is liquidity, liquid. Keeping it open can be used. It's practical and good sense to do that in any case, because if you're doing a self-managed super fund, you don't want to put every last dollar into it and have zero balance for everything else. Because how are you going to make those initial payments before it's tenanted? How are you going to have funds there in case you need to put maintenance work on the property, etc.? So that's just a little fun little thing there, which is the difference between many people borrowing and not. And most of the people we work with who have maybe talked to their bank prior have been told they can't invest because of their minimum balance requirement, when in reality, if they look at the right lender, they have the ability to invest years ahead of they otherwise would be able to and really build their portfolio at a better, earlier date. So get the right advice early, and at least that way you'll know, even if you're not there now, how do I get there in the future? That's a really important part there. So that's really the main sections there and how the lending side works. We'll go through an example that'll explain a little bit more about how it looks, and then maybe that'll give you a bit of an idea in your own circumstances where you are along in terms of the journey of whether you can start a self-managed super fund now, or maybe you need to do X, Y, Z to get there. Nice, simple example, a really common one. So a husband and wife, so a couple, we're going to say that they're both working. Husband on 100,000 as an IT professional. I could have said we picked that because that's our most common type of client, works in IT now. There's such a large amount. And we're going to say the wife is working part-time. They may have children and she may have reduced her hours at work, or for any reason really. Just saying that there's a disparity in income there between the two partners, and it can happen in any sort of circumstance. In terms of the current super fund balances, the husband in this case has 2 funds. So he's got 50,000 in an AMP super fund, really common if you work in a larger employment workplace. These sort of big funds end up being sort of your AMPs and whatnot. And let's say he's also got 50,000 with Australian super. The wife, she has 65,000 all in the one fund. So overall, they've got 3 funds. So the real benefit here in looking at one of them is they can consolidate that. It's going to simplify things a lot, maybe provide some cost benefits. It really comes down to their circumstances and what their advisor can really work out for them. Just with those incomes, that's their superannuation guarantee contribution. So that 9.5% which goes into your super every year, that worked out to around $13,775. So just going for that, based on their total things, they've got 165,000 sitting in their super funds combined. Let's say they're looking at a purchase of 400,000 and it rents at $400 a week, fairly close to neutral, something that's not too uncommon in Australia. You really see that stuff quite often in the sort of the Adelaide, the Brisbane markets, the outer suburbs and some of the other mainland cities. Obviously not Sydney. It's sort of a thing that you really have to work with the markets which are available. In this example, we've gone for let's go for the 70% LVR. In this scenario, we would suggest that perhaps they're doing this because they want an offset account, they wanted a bit of the extra features, and they're happy to put that larger deposit in there, have that lower loan. So that in that circumstance, they've got a maximum loan of $280,000. The deposit required, they would need to put in $120,000 to meet that 30%. They've also got government charges, so your stamp duty, your registration fees are estimated at $19,520. And we've got lender fees there, which we've put at the upper end of what some of the lenders are charging, around the $2,215 mark. In this example, we've also just said that they've had monthly fees, which work out to an annualized amount of $204 a year. In setting up the self-managed super fund, so that's what your accountant and a financial advisor would set up and advise you on. We're just saying that to do all of that, set up the company's trusts and whatnot, the corporate trustees as we spoke about earlier, we're estimating that would work out to say $5,000 all up. So the good thing is after you've done that, if you want to buy more properties in the future, you're not duplicating those expenses. They're done, they're dusted, they're nice and easy. And we're saying the accounting administration is at $2,000 a year. I can tell you the cost of administration of a self-managed super fund has dropped dramatically. Once upon a time, that was around $5,000 a year. And realistically, you can go downwards of around $1,000 a year, if that, to get your accounting done for your administration of your self-managed super fund. So what we've done is we've used some really conservative figures in there just to show it's still possible. You'll find that you can probably get those costs down quite a bit. But make sure you're getting good service for what you're paying for. You don't want to be cutting corners and then find out you've got a bit of problems. I had a person recently which was referred to us, which was having a bit of trouble. They went for a DIY route with one of the online providers for that. When it came to doing finance, it got checked by the bank's solicitors who check to make sure you are compliant. They were found to be non-compliant with the purchase due to the DIY online setup. And it came down to one simple thing. In their purchase contract to buy the property, they noted that in part of it, it was as an office-based sort of property, a commercial related one. It included the fixtures inside the kitchen, which included a microwave and dishwasher. Now, that was specifically noted in there. And when you're buying doing a self-managed super fund, the loan must be for one property only. You can't buy 2, 3 properties or other assets with it. Now, a dishwasher and a microwave count as separate ones. So they could have technically become non-compliant and been fined thousands, if not tens of thousands of dollars over a used microwave and dishwasher. So that's where you want to get really good advice. And thankfully, the bank solicitors did find that out, but they're paying for the solicitors to go through that. So overall, with all those little checks they did, it ended up costing them thousands of dollars more for the banks, the solicitors, to double check every fine-tooth piece of that just to make sure it was all right. But overall, that's a lot better than being found non-compliant and have the tax office or the Securities Investment Commission knocking on your door. The other costs of general property ownership, we've put in there just the insurance, water, council rates, maintenance, property management fees. We've put it all there at around $5,000 a year. Once again, that can be significantly less. It depends on where you're buying, what you're buying, etc. But what we've done is just give us some real simple numbers because it doesn't need to be complex. It just needs to be something which will help you understand what is possible. So in that scenario, they've bought themselves a $400,000 property, it's renting out for $400 a week. They're getting that $13,775 coming in each year as well. So where does that leave them? They've got income coming in of around $34,500. The total expenses are around the 23.7 mark. So that leaves them with excess cash flow every year coming in of $10,879. Now, if they had that loan on an interest-only loan, which would be quite common, 5 years interest only, roll it over to future ones, or even a 10 years interest only, they then also have their funds available, any excess funds they can put into offset. Over a normal 30-year loan, what they would find is, just without making any additional contributions and not even factoring in rental increases here, after 13 years, that house would be fully paid off. So what in reality, we would have all those funds in the offset account, because you don't want to necessarily deleverage completely and lose your ability to buy other things, because you may find that there's another property you want to also buy and have 2 properties. So it'd be great to have those funds available, because you just can't redraw them. You can't draw the equity back out. Keep it in the offset if possible. So where that leaves you is in 13 years, you've got, even with zero growth, a $400,000 property. You're starting with a fund balance of $165,000. To go from 165 to 400 in 13 years is fantastic. You can imagine, if you do this with multiple properties, the value and the power behind this. So that's where using leverage to your advantage and using a bit of smart thinking about what you can do with your investment can be really useful. We've also factored in this scenario that they'd have a liquidity amount of 20%. So they're leaving that 10% just left behind, sitting there doing nothing. So if we actually factor that into that offset account from day one, that would shave another year off it straight away. So we've really kept this conservative, and you can see the results are pretty significant. You can make the judgment there, where does that really leave you long term? But it is something which can be modelled out. And it's something that, if you speak with your advisor about, it may be something which you can replicate and buy a number of these properties over and over and then go again. You can also do other things such as extra contributions and the like. I'll get Justin to talk about that in a minute. But what you can see here is, on a base level, that is a structure which can really work to your advantage and really keep going from there.
Right, there's some other considerations that you need to look at when setting up a self-managed super fund. Here's Justin, who will go through that with you now.
Hi guys. So one of the things you have to look at is what insurances do you have in your existing funds, and will you lose them by rolling over to a self-managed super fund? Most of the time it's yes. So you want to make sure that you've got advice in that area before you do anything. Another thing is, do you have enough funds to start up a self-managed super fund now? Is it practical or possible to commit to a purchase with what you currently have? Or do you need to add some extra money in, or look at some other options to get you there? Another thing, how are you going to manage your self-managed super fund? Do you have good relationship with your accountant who has expertise in this area, or do you have time to do it yourself? Or what are you going to do? Another thing Corey can help with is, how will this impact on your other lending potential? So if you've got some other plans to borrow to buy some other properties non-super, how is this going to have an impact on that? If you're unsure about any of these, or about the self-managed super fund in general, make sure you just get specific advice. It's very important that you do that. Some common questions that we get. One is, can I buy an investment property? Answer is yes. Another one that people try and do or ask about is, if they own an investment property now, can you transfer it to your self-managed super fund? Answer is no in that scenario, unless, of course, it's business real property. So if it's a business premises, then the answer is yes. Another thing, sometimes people will want to buy a property that their kids or someone can live in. You can't do that. It's just against the rules, because it's using it for other things apart from investment. Similarly, with a beach house or family holidays, you just can't do it. And that's it. So what do you do if you don't have enough money inside superannuation yet, there's still some things you can look at. One of them is to have an advisor review your existing superannuation arrangements and work out what you currently have, how it's invested, what the structure looks like. There's a lot of people that we see have multiple superannuation funds, or funds that are really old and expensive, charging them higher fees. So just getting that on the right track can be the first step. Another, you can consider some strategies to get to your goals quicker. So you can add extra money into super, whether it's via salary sacrifice. You can put in spouse contributions. You can put in government co-contributions if you're eligible. You can consider, is the property that you want to buy, can you find something cheaper or for a lower purchase price? But the first step is working out exactly how much do you need, and so then you can sort of plan how long it'll take to get there. And another thing which is quite important is, prior to doing any of this, you want to review your current levels and structure of insurances, so whether it's life or income insurance, to make sure that you can easily transfer it over to a self-managed super fund where applicable. What we see quite often is a lot of people's health has changed since they've taken out the original insurances, and then when they go to set up a self-managed super fund, they can't get any new cover, so they have to keep small amounts in their existing super funds, which is just a bit messy, and it can be avoided if we pre-plan and look at some things.
Perfect. Thanks for that, Justin. So really, that's really the main things there. It's very simple. We've kept this one simple. There's going to be a lot of information coming out soon, which is going to be going into more of the nitty-gritty, a bit more of the complex. But just by the nature of how personal and how separate it is for self-managed super funds, you really need to get that specific advice, find out what's specific to you, because different professions have different rules. Whether you're a government employee, defence employee, whether you're young, old, it really depends what's right for you. So overall, I definitely suggest it's a really good opportunity to look at. Most people disregard their self-managed super funds as an option, or super as part of their investments, and they really should look at it. What most people don't realise is actually 1/3 of all funds in Australia are actually in self-managed super funds already. So while you may consider it and say, is this something a little bit out of the norm? Not really these days. It's really coming out to becoming a normal part, and most people think it's going to make up almost 60% of it over the next 10 years. So if you can get in there now, set it up right, then at least you know that it's actually working for you and that you're making the best use of it. The last thing you want to do is the big retirement nest egg, that even if you plan on retiring earlier, it's great to have as much funds there, because you will receive this one day. Unless there's, barring medical illness, which doesn't get you there, but in any case, you want to make sure you're set up as good as possible for the future. We normally do a Q&A on here, but what I would say is, just because of the technical nature of it, like, we're happy to talk to everyone. I've got our email address on there. You can email info@precisionfunding.com.au or info@precisionpw.com.au. And if you email there and just note webinar in the email, Justin or I will be able to answer any of your questions that you have, just because the nature of self-managed super, it's going to be really difficult for you to answer questions. And it might just be that there's some real technical questions that we can talk to you about, but it may take 5-10 minutes on the phone. So it'd really be great to be able to give you that sort of full information, because sometimes people who get told they can't do something actually can. We've had that even today, clients where they're told by 4 other people that they can't invest in self-managed super funds, who actually can. It's just that they really were getting the wrong advice from day one. So that really wraps it up, guys. What I'll be doing is I'll be sending out a copy of this video in the next day or 2. I'll also send out a follow-up article shortly as well, which will explain everything in a bit more depth. And over the coming weeks, you'll receive a bit more info on this area. If you do want to get any information specific on your circumstances, just let us know. We look at people's ability to get finance within a self-managed super fund, the practicality of it, and whether they have that potential to start up a self-managed super fund now or maybe in the future. That's at no cost. We're doing that. We can give you a full-on fees. If we can find something which really works for you, we'd really like to be able to do that. Likewise, Precision Private Wealth can look at your current superannuation setup, whether it's if you've got the right setup currently. They can look at if you aren't there now, make sure that your current super setup is efficient as possible to help you get there quicker. The last thing you want to do is be, like Justin said, be sitting in an old fund paying 4 times as much as you should be, which might drag out your ability to get into a fund by a year or more. Get it set up properly, get it working right, build yourself your portfolio and go from there. So thanks for coming everyone tonight. I hope you had a good night and I'll send that to you shortly. You guys have a great evening.